Hi, this is Professor Cataldo. I'm going to walk you through the remeasurement method of accounting for foreign currency. I did a YouTube video on the translation method, but I've gone ahead and included the slides here. So this is the translation method. That is the easier of the two methods. Both the translation and the remeasurement method are US GAAP methods. But if you've not gone through it, go through the translation method first. It's kind of like learning how to do straight line depreciation before you learn how to do double declining balance depreciation. It's just much easier if you go through that process. So I've been flipping through the slides for the translation method. It is precisely the same fact pattern for the remeasurement method. This is out of a textbook I like to use for my advanced financial accounting course. And on January 2, Padre Corporation, a U.S.-based company, formed a new subsidiary in Honduras, Sucursal Inc., with an initial investment of 150,000 Honduras lempiras. Assume that that firm purchased inventory evenly throughout the year. Okay. Ending inventory was purchased on November 30th. They use straight line depreciation. They declare and pay dividends on November 30th, the same date for both declaration and payment. Purchase fixed assets on April 1st. They use the US dollar. And we're going to go through and remeasure these financials. Now, on these financials, notice all the debits are on the top, all the credits are on the bottom. So it's not in balance sheet income statement format per se. It's debits on the top, credits on the bottom. We have precisely the same exchange rates that I used in the translation example. And you're going to do precisely what you did under the translation method, but a few additional steps, a little bit more complexity. So the exchange rates are reproduced above, and they're color-coded. Beginning inventory was 0, of course. Notice that they're using the exchange rate on the event date of the inception of the corporation, January 2. Purchases during the period, they're using the average rate. Period of time, use the average rate, period of time. They arrive at a measure, goods available for sale. And the ending inventory is as of November 30th, as previously given. And so we end up with a blended rate for our cost of goods sold. And that's why they have footnote A here. This is the remeasurement method. I'm going to go through some of the differences between the remeasurement method and the translation method. First of all, from the top to the bottom, inventory is different, more precision. That is the inventory event date of November 30th. Property, plant, and equipment, we had a precise event date of April 1st. We're going to use that exchange rate. Cost of goods sold, I already went through that. We went through a computation or a calculation with greater precision. Depreciation expense. Notice they're using the same exchange rate for depreciation expense as they are for plant and equipment. And down below, the same exchange rate for accumulated depreciation. Let's put that a different way. Property, plant, and equipment in this first year of operations. Accumulated depreciation, the related contra asset account in the balance sheet. And depreciation expense, the item in the income statement, are all going to use the same exchange rate. And the exchange rate is going to be associated with the event date of placing in service, purchasing and placing in service the property, plant, and equipment. Other expenses is an income statement item. We're going to use the average rate. Dividends, same as translation method. Accounts payable, bond payable, mortgage payable. Event date at the end of the year for the balance sheet, point in time, same as the translation method. Common stock, same as the translation method. Sales, same as the translation method. Sales occurred over a period of time. We're going to use the average. Let me recap. I'm trying to do these PowerPoints quickly. So what is different between the translation method and the remeasurement method? Greater precision with respect to event dates for inventory, a balance sheet account, and cost of goods sold, the related income statement account. The same with property, plant, and equipment, accumulated depreciation, and depreciation expense. That is the difference between the translation method and the remeasurement method. Greater precision in the inventory and cost of goods sold related accounts, and greater precision in the property, plant, and equipment, accumulated depreciation, and depreciation expense related accounts once again. Now, as I mentioned in the translation method, YouTube, your debits are not going to equal your credits because you're using different exchange rates on each of these items, on all your debits and credits. In this particular case, we have a remeasurement gain of $443. That's our plug. And that is the remeasurement gain placed in context. It's in red. $443. Understand the translation method first, and only then go on to the remeasurement method. Thank you.